Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, February 9th, 2024. As always, we'll start with the executive summary from today's lead off morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro events, which is the annual US CPI revisions and solid Treasury bond auction demand were supportive of Goldilocks. Plus, Beijing continues pushing on a string, but the Chinese Communist Party's desperation is supportive of Goldilocks anyway. So the nuance there is today is 8:30 a.m. The BLS published its annual revisions to CPI. In our view, the revisions were not extreme enough to materially impact rates pricing. It would have taken more significant and broader positive revisions to change the FOMC's collective assessment of inflation trends. Elsewhere, yesterday's 30-year Treasury bond quarterly refunding auction of $25 billion drew solid demand per the award rate of 4.36%, being below the 4.38% when issued yield. This follows solid demand signals from the 3-year and 10-year Treasury note auctions this week. Lastly, China's January credit data were supportive of our view that the PBOC would front-load policy support early in the year. From a market implication standpoint, the Goldilocks market regime survived 2 tumultuous weeks of critical macro, micro, and policy updates. We believe the fundamental conditions are in place for a continuation of risk-on market conditions into the mid to late spring, if not the summer. That said, our positioning model continues to flag elevated risk of across-asset corrections stemming from multiple indicators. Thus far, the sell-off in the Treasury market has yet to materially impact risk assets, likely because hard landing holdovers were forced by the data into upside capitulation, a behavioral phenomenon we explicitly called for at the start of the year. At any rate, we expect fresh bulls to find much better pricing to buy into a month from now. Transitioning to my 42 macro dashboard here. As always, we'll wrap up with a question from our community. We got a question here from a subscriber that reads, hi, Skipper. I was finally reviewing the Around the Horn for the February 3rd. I was wondering about slide 44 on the U.S. Treasury coupon forecast. I was wondering if the net supply takes into account QE from 2020 to 2022 periods and the QT period we are facing now. How would the numbers look? I thought the Fed was doing $120 billion a QE a month during that period versus net nominal bond issuance of $120 billion during those quarters. So a few things on this. So let's start with the QE QT part first, because I think it's important to unpack that. The Fed is not doing quantitative tightening. Recall that quantitative easing is when the Fed buys bonds from the secondary market to basically force a bullish portfolio rebalancing effect throughout asset markets. Refer to our friend Andy Constant for some details on how that process works. He's got some great insights out there for that. In terms of what the Fed is doing currently, they are currently implementing a process that we are calling balance sheet roll-off, whereby 0 DTE maturing Treasury securities on their balance sheet are actually no longer being reinvested into longer-term Treasury securities on the balance sheet. Recall that when bonds mature, or not, they're not even bonds; they're just 0-day Treasury securities. When those mature on the Fed's balance sheet, the Fed reinvests the proceeds of those maturities back into, let's call it a 10-year bond or 7-year bond, depending on what the original bond was purchased for. They'll reinvest that back into that same tenor, or the original tenor of that security, to maintain the same size of the balance sheet. So what the Fed is effectively doing is allowing those things to roll off their balance sheet. They're not selling bonds into the market. They're just not allowed. They're just no longer reinvesting up to the tune of $60 billion a month of Treasury securities and $30 billion a month of mortgage-backed securities. When the Fed was doing QE, it was explicitly buying $90 billion a month of Treasury securities and $30 billion a month of mortgage-backed securities from the secondary markets, again, forcing those investors to effectively swap a high duration asset with a zero duration asset, i.e. cash, and forcing them to find other avenues in asset markets to put that cash to work, assuming they wanted to maintain the same risk profile, if not extend their risk profile, given that the Fed was pursuing easy monetary policy at the time. So that's on the QE QT side of things. So when we think about answering the first part of the question, when we think about net issuance from the perspective of the Treasury market, we want to think about those things independently from Fed policy, because in order for us to have consistently accurate forecasts for things like liquidity, U.S. liquidity, global liquidity, we need to understand all these moving parts and critical dynamics independent of one each other, so that when something changes in that ecosystem, in one part of the ecosystem, we can make inferences upon how that might impact the other elements of the ecosystem. If you're mashing it all together and saying, well, this is adjusted for QE, QT, and this and that, then it becomes a lot harder to forecast where the system might be in the future state, because you're losing information from those kind of more granular parts. So that's something I think is very important, and you'll see in 42 Macro research that's very different than what a lot of other investors are doing with their research. It's just trying to create big narrative type conclusions based on jamming everything together because it's the easy way out. We don't take the easy way out in our research. We are doing the work daily, rolling our sleeves up and grinding daily through all the data so that we can spot critical inflections in key factors and features in real time that ultimately impact our broader view of where asset markets or important functions for asset markets like liquidity, U.S. liquidity, global liquidity are headed. I think we do that at a very high institutional, top end institutional level, which is why so many of the top firms on Wall Street across the global buy side I love working with us and have worked with us for years now. So we'll wrap it up there. Thanks for joining us. We'll catch you back here on Monday. Everyone have a wonderful week out there. We'll see you soon. Cheers.